Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to customer payment terms and discount policy, getting into more detail about the decision-making process as to whether a discount policy would be beneficial or not. Get ready. It's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to, but if you have access to it and would like to, we are in the 734 Customer Payment Terms and Discount Policy tab in the Practice Problems section. Closing this back out, we're going to have our information up top. We'll go through that information, then we'll have a smaller component of it that we will use to work through the practice problem. Note we're going to have two practice problems that we will be comparing and contrasting with, and each of those practice problems will be comparing and contrasting two scenarios. First scenario, meaning we have a terms for when we expect to be paid on our credit sales, and then we're going to think about what those starting point will be with regards to our accounts receivable turnover, and then we'll think about putting in a discount and see what the effect of that discount will be and whether or not the discount will be a beneficial thing to do or not. And then our second problem will take into more detail in terms of the possible effects of a discount could have, such as increasing the credit sales. What if we offer a cash discount and we assume that the credit sales will then increase due to the fact that the price has now gone down with regards to our overall price? All right, so let's see what we have here. We got the credit sales up top are going to be the $435,000. So we're estimating credit sales on account. Sales are going to go through accounts receivable. We give the invoice when we do the work. Haven't got paid for it yet. We're going to get paid at some point in the future. We have the payment terms being 50 days. So they need to pay us within 50 days. If they pay us outside of 50 days, then we might take collection action. We might charge penalties or something like that, or we might go and take collection action at that point in time. And the average collection period then is going to be 50 days, we're going to say. Now, again, if you're selling to individuals, they may pay you, sporadically anytime within the 50 days. Obviously, we would like to get paid sooner with regards to our cash management process, because remember, with regards to cash management on the receivable side of things, we would always like to get paid sooner rather than later. So, but if we have business-to-business customers, for example, or more this is going to be applicable more to business customers for sure, because they're going to be implementing the same cash management strategy, which is going to be that they want to pay as late as possible. So they're going to hold on to the money as long as they can, because that's basically standard cash management policy. Therefore, if our clients are business clients and we have 50-day terms, we're going to assume they're not going to pay us until the end of the 50-day term, as they try to hold on to the revenue, the money, as long as possible for their cash management process. So our goal here then is to say, well, I'd like them to pay us sooner than that if possible. That's just like the outside time period when we want to get paid, but we would totally be appreciated if you'd pay us at a sooner point. So how can we get them to pay us at a sooner point? So then the customer pays at the latest possible date. That's what we assume. The proposed adjustment then is to say, okay, what if we have the $435,000 credit sales and we offer a discount? So you could still pay us within the original term of the 50 days before we take collection action or anything like that, but we'll give you a 2.5% discount if you pay us within 15 days. Now again, 2.5, if you go to a retail shop and you say, I'm going to buy some clothes or something, and they say, oh, I'll give you a 2.5% discount, you're going to be like, that's not that big of a discount. That's not very impressive. But when you're thinking about payment terms, payment policies, and you're thinking about the fact that they're only paying us at the end of the 50-day time period to get the benefit of the time value of money, as they hold on to the money for a few more days until the end of the payment term, which is only 50 days, then we don't need a big discount to change the cash management policy from that standard to something else. We can give a little discount and say, hey, if you pay us in 15 days, then we'll give you this 2.5% discount, whatever small benefit, which could be large over a lot of transactions, but any small benefit you're getting from one transaction will be now void if the only reason you're waiting to pay us is for your cash management strategy. So that's going to be the objective here. We put in a 2.5% discount if they pay us within 15 days, assuming then they're going to pay us all our business clients that just have this cash management strategy of paying us as late as possible will now switch over to paying us within 15 days, because it would be more beneficial given the discount to do so. So that's going to be our objective. And so we're going to assume now that they're all going to pay us within the 15-day time period and see what the adjustment will be. Now, when thinking about whether or not this is a good idea or not, it will clearly increase our accounts receivable turnover, which is great. We'll get paid sooner. That's great for cash management purposes, but we're going to have to, have less cash that we're going to get because we're going to be given a 2.5% discount. We need to counterbalance those two things, see whether or not it's going to be beneficial to do so. So now the return on the freed up money, we're going to say there's going to be a 10% return. So if we free up this money, if we get the cash sooner, we did our cash management, we got the cash sooner, is that good or bad? Well, it depends on what we can do with that cash. If we can pay down debt, for example, where we would pay interest on the debt, if we had not paid it down, then we could save basically 10%, we're going to assume here, on paying down debt with that added cash. Or if we can invest it somewhere for that time period and get a return on it, then it could be something that is beneficial, and we'll have to counterbalance that against the discount that we had to give. All right, so then we have our information down here, down below, in smaller kind of detail. We'll work through this. We're going to say, all right, the average collection period. Now the first thing we're going to be figuring out is the accounts receivable or average accounts receivable, so we can use that to figure out our turnover and figure out what our starting line kind of turnover is before we make the adjustments to the new proposal. So we're starting at this proposal here. Our baseline terms 50 days. Everybody pays us at the end of the 50-day time period. I'd like to know what the average accounts receivable is on those credit sales. And to do that, we don't figure a new formula because accounts receivable is something on the financial statements. I want to use one of my ratios to back in algebraically to the unknown, which is going to be the accounts receivable we are projecting out. So we have the average collection period. The calculation or formula for the average collection period is accounts receivable or average accounts receivable divided by the average daily sales. So let's use that formula because that's the one we would basically be memorizing, right? Because we don't have a formula to calculate accounts receivable. We're just using the algebra to back into that formula. So this formula would be the unknown, which is yellow. That's why it's unknown. And then we're going to calculate the average daily sales. Again, the number's there, but it's yellow. So we're saying it's unknown just for our practice here. So then we have the credit sales are going to be the 435,000. The days in a year, we're going to assume nice even 12 or 30-day months. So 12 times 30 would be 360 to give us the 1,208, which is going to be, let's pull out the trusty calculator just for the fun of it, and we can plug it in the calculator, see if there's any rounding. 435,000 divided by 360 is going to give us about 1,208. And then if we took then our ending number is the average collection period, which we know up top it was 50. Sorry, 50. So that means we have X divided by, if we write this out algebraically, X divided by the 1,208 equals 50. Solving then for X would mean that we have the 1,208 about times 50. And that'll give us about the 60,400 because, again, this number was rounded. It was actually 435,000 divided by 360. It's actually this number times the 50, and that would give us the 6,417 about. And then if I calculate it again, I'd say 6,417, just to double check it, divided by the 1,208 would give us then 50. Now, if we were to rewrite that, or if you were to ask somebody about the calculation, they would give you a calculation as if you need to memorize the formula for accounts receivable. So we're going to do the same thing, but note this is just reworking the algebra. So we would say, okay, the average collection period, and then we have the average daily sales, which is same calculation, the 435, days in a year, 360, giving us the average daily sales, 1,208. Once again, the 50 times the 1,208, giving us that 60,417, same calculation we had up top. Up top is the way I would recommend thinking about it. This is basically just simply reworking the algebra, but the way that you will probably see if you were to ask someone or look at a book problem or something like that. Then we have the accounts receivable turnover, something that we can then calculate now to determine, compare and contrast how our turnover is compared to prior standards or industry standards. We're going to take the credit sales, the 435. We're going to take the accounts receivable, the 60,417 that we had calculated. We will divide them out. And once again, remember, there will be rounding involved here. So we got the 435,000 divided by the 6,417. That's going to give us about the 720. That's our starting point. That's going to be our starting point. And then we're going to say, okay, now let's compare and contrast that after we give the discount, assuming then that everybody's going to pay us in 15 days rather than the 50 days, because we have all business clients and they're all just trying to wait till the end of the time period to get an advantage on their cash management. But now the discount, the small discount, is going to reverse that whole thing and make everybody want to pay us within 15 days. So we're going to say, all right, now what's going to happen? We're going to calculate once again the average receivables. Same process. We're going to do it up top using the average collection period, which is going to be the accounts receivable divided by the average daily sales. But the end result is now 15 rather than 50 because everybody's going to be paying us within 15 days. So the accounts receivable would be the unknown. That's why it's yellow, even though there's a number in it. Average accounts receivable is going to be that 435 divided by the 360. Same thing as it was in the past here. That gives us the same 1,208. Remember that is rounded. And that then the end number is going to be 15 as opposed to 50. And therefore, if we write this out algebraically, we would have the unknown divided by the 1,208 about equals 15. And then we can solve for then the unknown. And remember, there is rounding involved here. So we're really talking about the 435,000 divided by the 360. This number, 12,000 or 1,208. And then if I take that and multiply it times the 15, we get to this 18,125. If we want to get back to the 15, the 18,125 divided by the 1,208 gives us the 15 about. Now, we can do that again. If you were to see this in a book problem or ask somebody, they would then redo the algebra as if you need to solve for accounts receivable or memorize that formula. You don't. You just need to plug it into the prior formula we looked at. But if you were to rework it and you were to see what someone would give it like this way: average collection period divided by the average daily sales. Once again, the credit sales 435,000 divided by the days in the year 360. To give us the average daily sales 1,208. 1,208 about times 15 gives us once again that 18,125. Now we can calculate the turnover, which we expect to be much better now. So the accounts receivable turnover, we got the credit sales are going to be the 435, and then we have the average receivables we just calculated here. If we divide that out, then we get about 24, or looks like exactly 24. So we got the 435,000 divided by 18,125 is going to give us 24. So we have a huge increase in our receivable turnover, which means we're turning over, collecting faster on our receivables. That's really good. If we compare that to industry standards, we're going to say, wow, that's great. But then the question is really, are we still benefiting? That doesn't really let us know if we're benefiting or not. I mean, what are we doing with that added cash? Is it better to get that added cash sooner? Because we have to basically account for the fact that we have a 2.5 discount that we had to deal with, which means we're getting less cash on the sales. So let's think about the cash that was freed up. We're going to say the freed up cash is going to be the 42,292. We're going to say, how do we get that? We're going to say that's going to be the accounts receivable up top that we calculated, which is this item, the 6417 minus the average accounts receivable after we did the second calculation here. So minus, which is this 18,18125. So now we've got the freed up cash because we're collecting faster on the accounts receivable at 42,292. And so then what are we going to do with it? Well, if we can get a 10% return on it in some way or another. In other words, if we had debt that we're going to be paying off and we have to pay 10%, if we could pay it off sooner and save that 10%, or if we could take that 42,292 and invest it somewhere to get a 10% return, then we can say that the value of us getting that money sooner would be 4,229. We're going to say 4,229 value of getting that money sooner. Let's compare that to the money that we're going to lose for the fact that now we're going to have a discount of 2.5. We have the same amount of sales. It didn't increase the sales amount. All it did was make us get paid faster, but we're going to lose 2.5% on it. So we're going to say, all right, the credit sales are 435. The discount is 2.5. So 435 times 2.5 or 0.025 is going to then give us the 10,875 that it's going to cost us for this policy. So we can see then the return was only 4,229, but we're going to lose 10,875 with it to get paid faster. So The fact that our cash management is better, we're getting money sooner, does not outweigh the fact that we have the discount loss on the discount that we're providing of the $10,875. So it's not a good policy at this point. Now, what could we change? You might say, well, what are the factors that could change to make this possibly a good policy? Well, obviously, one, we can say this 2.5, maybe we could lower it. Maybe we only needed like a 1% discount to get people to stop their cash management strategy because they're only waiting another 50 days for their cash management strategy. So you can think about the discount. What would that do? You can think about when they're going to pay us. Maybe we lower it from 15 days to 10 days. You pay us within 10 days, then possibly that would be a strategy we could use. If we can take that money that we have and pay off debt, and if we were paying off debt that had a higher interest rate, so if we were paying off 15% interest rate debt, or we can get a return of 15%, that can make it a more worthwhile activity. And if we think about this credit sales over here, note that if we give a 2.5% discount, we assume that the credit sales were staying stagnant. Not necessarily the case, because now basically the sales price is going down. And typically economics would tell us that if the sales price goes down even by a little bit, you would think possibly the sales would be increasing. So maybe this small discount will have an impact on an increase in sales, which could be another factor we'd have to take into consideration. Let's take a couple of those factors into consideration with our second practice problem. So we're going to say the credit sales are $780,000 this time. Payment terms are going to be 30 days, so that they're going to pay us within 30 days. That's going to be our baseline point. So we're assuming, once again, that they all do pay us within 30 days or at the end of 30 days. They all wait 30 days to pay us in order to maximize their cash payment strategies, which was what we might expect if we had all business customers that we're dealing with. So they all pay us at the end of the 30 days. Our proposed adjustment, credit sales, if we do this adjustment, we think that credit sale, which is going to mean we have a cash discount again, but if we provide the cash discount, we think that credit sales, due to more competitive price, will increase by 10%. So we're thinking the credit sales are now going to be increasing due to the cash discount that we have. That's a new factor, fairly significant increase for just like a small discount that we're offering, but that's going to be our factor. Then we got the discount that's going to be offered if you pay within 10 days. So now we're not saying 15 days. We want to get paid within 10 days, and you get this discount. The discount is only 2% now, so a pretty small discount. But again, the small discount could have an impact, especially from business-to-business clients who are only holding on to the money for cash management strategies. They're not getting a big benefit from it, and we're just trying to get paid a little bit faster here. So customers pay at the last day of the discount period. We assume that all of our business-to-business customers, which they all are in our example, we're assuming, are going to switch over now to pay within the 10 days in order to take advantage of the discount, because that would be the smartest thing to do with regards to cash management strategy. Return on the freed up cash, we're going to say with that freed up cash that we get, because we're getting paid sooner, we can either pay off loans that we had interest of 8%, or we can put it in an investment to get an 8% return. And then the profit margin is going to be 25%. Here's our information down below. That's our normal profit margin, we're going to say. Here's our information down below. Let's take a look at this and do a similar kind of work through on this. So once again, we need the accounts receivable so that we can use that to figure our accounts receivable turnover. To do that, I'm not going to look at a formula for accounts receivable, because that's on the financial statements. I'm going to use the average collection period. This is in our baseline strategy, our starting point, where we have 30-day terms. We expect to be paid within 30 days, and therefore everybody pays us at the end of 30 days because they're all waiting till the end of the 30 days, even though we would totally like to get paid sooner if they would. But, that's the last day that pay us, so they all wait. So we have the average accounts receivable. This is going to be the average collection period calculation, accounts receivable divided by the average daily sales. We're going to back into this accounts receivable number once again, and we're going to then calculate the average daily sales. Credit sales are going to be 780,000 divided by the days in the year. If we assume 30-day equal months, 30 times 12, 360, to give us the 2,167. And then we know that the end point, the average collection period, is 30 days. That's going to be given to us, and therefore we are backing into the unknown, the yellow item, the accounts receivable. We can write that algebraically as X divided by the 2,167 equals 30, and then solve for, and we would have 2,167 about times 30. We get this. It's rounded. Why? Because we really have 780,000 divided by the 360, which is really that number. So it's rounded. And then we could take that times 30. and we get the 65,000. To double check it, if we take that 65,000 and divide it by the 2167, we get once again about the 30. So then we're going to say that we could calculate that accounts receivable this way. This is how you might see it in like a book problem, or if you were to ask somebody, they would act like you have another formula that you need to memorize. You don't, but this is what it would look like. 30,000 for the average collection period, average daily sales, credit sales 780,000 divided by the days in the year 360. That gives us about 2,176. So once again, multiplying that out, the 30 times the 2,176 about gives us that 65,000. We can then use that to figure our starting point accounts receivable turnover to be able to compare our turnover to the past and industry standards, taking the credit sales 780,000 divided by the average accounts receivable we just calculated, 65,000, to give us our turnover of 12. So that's our starting point. We want to improve that turnover, increasing that turnover with the use of the discount, now providing a 2% discount if paid within 10 days. And we think everybody's going to pay us within 10 days because we have all business clients. So now everybody pays us in 10 days to get that 2% discount. Because they're only paying us within 30 days to maximize their cash management strategy. And now it would be beneficial to pay within 10 days. So now we're going to say the accounts receivable, we're going to do the same calculation, looking for accounts receivable, but we're going to use the average collection period to do so, which is now 10 days. So accounts receivable would be the unknown. It's yellow. We have a number in there, but it's yellow. That means it's unknown. And then we have the average daily sales, which is going to be the credit sales, which is now 858. Because remember, we also have this factor that we think that the discount is actually going to increase our sales because we lowered the price. So what would that increase be? It would be 780,000 times 10%, 0.1 increase plus the 780,000, or you can take the 1 plus 0.1 or 110% times the 780,000. That would be the 858,000. So we have increased sales. And then we're going to say that the days in the year are 360 to give us about that 2,383. And we know then that the average collection period is now 10 days because they all pay us within that time period. All right, so then we could say, remember, this 858,000 divided by the 360 would give us this number. It's rounded. So now we have the unknown divided by the 2,385 equals 10. So if we take this number times 10, we could solve for the unknown, 23,833 about. If we double check it, the 23,833 divided by the 23833 about, let's do that again. If we take the 23,833 divided by the 2383 about, we get about 10. So we can double check it. Now, if you were to rewrite this and ask somebody or take a book problem, they would do the same calculation, but act like you need to memorize accounts receivable or another formula to do so. You don't, but it would look like this. Average collection period 10, average daily sales, credit sales, days in a year, dividing that out gives us about the 2383. Then the 10 times the 2383 giving you the 23,833. The accounts receivable turnover then, now calculating as the credit sales, now up to the 858,000. And then we have the average accounts receivable, 23,833 about, which gives us about a turnover of 36. So once again, if we took the 858,000 divided by the 23,833, we get about the 36. So now this has increased a lot. So that's great because before it was 12. So that means we're collecting on our receivables sooner. That's really good. But now we have to determine whether or not that increase is worth the fact that we have to provide now a 2% discount. So let's see if we can think about that. Now to do that, we need to look at the increase in net income from the increase in sales. We have this new factor because we had an increase in the sales now. Now, if there's an increase in the sales, that's the top line item. We need to figure out the expenses related to that too, to figure out what the bottom line increase, what the bottom line net income increase is for that increase in sales to determine whether or not it was a beneficial thing. So for that, we'll take a look basically at like an income statement. So we got the increase in net income from the increased sales. So we had the sales of the 780,000 and then the profit margin of 25% to get the current net income. This is where the net income basically was before, right? Because the profit margin remember, it's going to be the profit margin is going to be how much we're basically getting of every dollar of sales at the end of the day at the bottom line. So it was at 195,000. Now, if we use that same profit margin and take a look at the new net income, now we're at sales of 858,000. That's the top line of the income statement. To jump down to the bottom line of the income statement, we used a profit margin. So we're going to use the same profit margin, we're going to assume. So the 858,000 times the 25% is going to give us the 214.5. So although there was a 10% increase on the top line, meaning sales went up by 858,000 minus the 780,000. So we had the 78,000, and then we could take 25% of that times 0.25. That's how much the bottom line went up. Or in other words, you can calculate the bottom line, which now we think is going to be the 2145. The net income on the bottom of the income statement minus the 195,000 is going to give us that 19.5. So that's what we think the effect of the increase in the sales will be. And so we're going to say, all right, so the return on the freed up cash is also a benefit that we had. So the freed up cash is 41,167, which is the difference in the accounts receivable or average accounts receivable, which was at, so we had average accounts receivable before of 65,000 minus, and now we've got average accounts receivable minus the 23,833. And so that's 41. That's going to be 41,167 freed up cash. What are we going to do with that freed up cash? We're going to use it in such a way that we get an 8% return, either paying off debt where we owed 8% interest on it, or we're going to be paying off, or we're going to put it somewhere where we're going to get an 8% return. If we utilize the cash that we're receiving, then we're going to say there's a benefit from the return of the 3,293. And then, so now let's think about the cost of the cash discount that we're providing. What's going to be the cost that we have? Well, we've got the 858,000 in sales. Now, this is a little bit tricky because notice sales increased. So it's a little bit tricky to figure out, what the cost of it is, but because, if we didn't have it, then we would only have 780,000. But in any case, we take the whole credit sales, and then we're going to multiply it times the 2% because we're going to get a discount. We're going to have to provide a discount. We're going to get 2% less, and that means the cost is going to be 17,160. So then if we add this up, okay, is this beneficial? Well, let's look at the gain or loss from it. We said the increase in net income is going to be the 19,500. The bottom line increase from the fact that there's a 10% increase in the sales due to the fact that we gave a discount, lowering in essence the price of the goods. We have the return on the freed up cash. So meaning we freed up cash because we're going to get it 10 days sooner, increasing our cash management strategy, and then we're going to get an 8% return or pay down debt that we owe 8% on. And then there's the cost of the discount, which we now said was 17,160, this cost up top. So now if we were to add that up, we're going to say, all right, well, is this a good thing? Well, we got the 19.5 plus the 3,293 minus the 1,7,160, and it comes out to a positive. So in this case, we were thinking the discount might be a good thing. Now, at this point in time, you might further do an analysis and think about whether or not the discount is going to have an effect in terms of like a return on investment type of calculation to see if the expected increase is worthwhile to move from the norm. Because remember, the norm is you have to argue sufficiently enough to make the change. Otherwise, the risk of making the change, you have to argue over the risk of making the change. So you might further take this down and say, well, yeah, there's a positive benefit, but is that over the threshold that we need it to be positive in order to move from the default position where we stand now, what we know, to something that we don't know, and taking on these risks to move forward with it.